part B of the required. First, you need to determine whether the manager of the cappuccino division will receive a bonus, and you need to show all your calculations. Then after that, you need to list, so don't discuss, just list 4 non-financial measures. So obviously you can't list anything financial, only non-financial measures. So let's just emphasize that over there. So list 4 non-financial measures that can be used to evaluate divisional performance in terms of the quality and efficiency of the manufacturing process. And once again, you are specifically told to ignore the special order in this part of the required. All right, so let's start with the first section. We need to determine whether the manager of the cappuccino division will receive a bonus, and we must show all calculations. All right, so if you go back to the information provided in the scenario, you are specifically told that the divisional managers are rewarded with a bonus of 80,000 Rand each if the residual income of the division exceeds 1.5 million Rand, and you were also told that the company's cost of capital is 16% per annum. All right, and we obviously need that cost of capital in order to calculate the residual income. So if we need to determine whether the manager of the cappuccino division will receive a bonus or not, first we're obviously going to have to calculate the residual income for the cappuccino division. If the residual income exceeds 1.5 million Rand, then obviously the manager will get a bonus. If not, he will not get a bonus. So that's what we need to do. Now guys, this was a very straightforward part of the required. You should have not struggled with this, so I don't want to waste your time writing everything out. Instead, I just want to make sure that you understand everything and you're following the correct approach. So our starting point obviously is going to be to calculate residual income. And what I recommend you always do is write out the formula, because once you have the formula, you'll then know what other calculations are necessary. And there's no excuse for not knowing formulas. You have to study the formulas. So if we jump to the suggested solution, how do we calculate residual income? It is controllable profit, and you subtract the controllable investment multiplied by the cost of capital. That is our formula. So first we need to calculate controllable profit. And please remember guys, this is controllable profit before interest and tax. So once again, if you go back to the scenario and look at the information that you've been provided with. For the cappuccino division, we've been given their profit before tax over here. And in note 2, we were specifically told that profit before tax was determined before the following income and expenses were taken into account. So if I'm trying to calculate controllable profit before interest and tax, please remember guys, we are only taking into account income and expenses that are under the divisional manager's control. That's obviously what controllable profit is. So I'm going to start the calculation with profit before tax over here, and then we're going to go through all of these items and we are going to determine what's controllable and what's not controllable. And we only take into account items that are under the divisional manager's control. And in order to determine what's controllable and what's not controllable, this paragraph over here on the first page is extremely important. That gives us a lot of information to help us determine what's under the divisional manager's control and what's under head office's control. Okay, so we are going to use all of that information. But start your calculation with profit before tax that you were given. Then the first item that we need to consider is interest paid on long-term loan. So we need to consider whether that is under the divisional manager's control or not. Now, if you go back, we were told that head office is responsible for all long-term financing agreements. So that is definitely not under the manager's control, the divisional manager's control. That is under head office's control. So that should not be taken into account in our calculation. But please remember, guys, don't just leave it out. If you leave it out, you're not telling the examiner anything. If I'm marking your paper, it looks like maybe you've just forgotten. So always show the examiner, because there's sometimes marks available for saying you are not including something because it's not controllable. So make sure you show everything, please. So you can see here, interest on the long-term loan is not controllable by the divisional manager, so it's not taken into account. Then next we have interest paid on bank overdrafts. So now we need to determine whether that's under the divisional manager's control. And it's important to note that you were told divisional managers are responsible for their own procurement function, including negotiations with suppliers, the management of debtors, capital investment decisions, day-to-day cash management. That's going to include your bank overdraft. All right, so the bank overdraft is definitely under the manager's control, so that needs to be taken into account in the calculation of controllable profit. Okay, so the interest on the bank overdraft is controllable and it needs to be taken into account. Then next we have training services. So let's see what we were told about the training services. Head office delivers the training services at a standard tariff to the divisions. Be careful. At the request of divisional management. So that is under the divisional manager's control. Head office only delivers the training services at their request. If they don't request training, they don't get training. So it's completely under their control, and the training services should be taken into account in the calculation of controllable profit. Simple, hey guys? Simple, simple, simple. Okay, what do we have next? Discount received from creditors. Is that controllable? Once again, go back. They are responsible for their own procurement function, including negotiations with suppliers. There we go. It's under the divisional manager's control, and it should be taken into account when calculating controllable profit. All right, and that's obviously dividend received, so it's income. Don't deduct it. It needs to be added. Then we have discounts allowed on debtors. And you were also specifically told that the divisional managers are responsible for the management of debtors. So that is under their control. So it needs to be taken into account in the calculation. All right, then we have depreciation. And depreciation is obviously going to be on capital assets or non-current assets like property, plant, and equipment. So if we go back, we were told that the divisional managers are responsible for capital investment decisions. So they get to decide whether they purchase non-current assets or not. So if that decision is under their control, then the depreciation on those assets is also under their control, and it should be taken into account in the calculation of controllable profit. All right, then we have head office admin fee. Let's do these two together. We've got the head office admin fee and we have sundry expenses. So first, for the head office admin fee, we were told that head office is responsible for all long-term financing agreements, and they also determine the rate and method of allocating head office admin fees. So that head office admin fee is an admin fee incurred at head office and is allocated to the divisions, and the allocation is done by head office. That's definitely not under the control of the divisional manager, and it shouldn't be taken into account in the calculation. Then for the other sundry expenses, you can see over here we've got other sundry expenses. That falls within the control of the divisional manager because they are responsible for other sundry expenses. So that should be taken into account. All right. So the head office admin fee is not controllable, not taken into account, but the sundry expenses are controllable and they are taken into account. All right, so that then leaves us with controllable profit before long-term interest and tax. And we've completed the first part of the calculation. So you can just include that over there. All right. Then, after we've calculated controllable profit, we now need to calculate controllable investment, and we're going to multiply that by the company's cost of capital. So first already, we can include the cost of capital over here in our calculation. Remember, you were told that the company's cost of capital is 16% per annum. So that's where that's coming from. Then we need to calculate the controllable investment. So you can see that calculation just below. Remember, guys, controllable investment is non-current assets plus net working capital. And net working capital is current assets minus current liabilities. So once again, go back to the information provided in the scenario. here we've got non-current assets, so we are going to obviously include that in our calculation. And then we need current assets minus current liabilities. So debtors is obviously a current asset, creditors is obviously a current liability, and the bank overdraft is obviously a current liability. We will not take the long-term loan into account in our calculation because financing arrangements are done by head office and not by the divisional managers. So that is not controllable by the divisional manager. All right, it's not under their control. Okay, so we've got the non-current assets, we've got debtors, creditors, and the bank overdraft. Okay, and obviously for the long-term loan, we don't include anything because we know that that is not under the control of the divisional manager. Now guys, normally in questions you're not given the level of detail that I've given you in this question. So sometimes it's difficult to determine what's controllable and what's not controllable. If you are not told anything, it's safe to assume that non-current assets, so capital investment decisions, are under the control of the divisional manager, and current assets and current liabilities are also under their control. It's also safe to assume that long-term loans or any financing arrangements are done by head office. So even if you were not given this information, it's safe to assume that you always calculate the controllable investments by taking non-current assets and then adding net working capital, which is your current assets minus your current liabilities. However, in this paper or in this question, I gave you a lot more information. So you were able to determine that the non-current assets are under the control of the divisional manager because they are responsible for capital investment decisions. We also know that the debtors and the creditors are under their control because if we go back here, they are responsible for their own procurement function, including negotiations with suppliers, so that deals with creditors, and they're also responsible for the management of debtors. We also know that they are responsible for the day-to-day cash management of the division, so that means they are responsible for the bank overdraft, or the bank overdraft is also under their control. However, the long-term loan is not under their control. All right, so that then gives you the controllable investment. And now that we have all of this information, we can wrap up this calculation and we can calculate residual income. So you can see here the Cappuccino division has a residual income of 1.652 million rand. So because the residual income exceeds 1.5 million rand, the manager will get a bonus. And if you go back to the information provided, you'll remember that he will be entitled to a bonus of 80,000 rand because the residual income exceeds 1.5 million rand. Okay, so he'll receive a bonus of 80,000 rand because the residual income of the division exceeds 1.5 million rand. Then next you need to list 4 non-financial measures that can be used to evaluate divisional performance in terms of the quality and efficiency of the manufacturing process. All right, so guys, so in the first part of the required over here, we used a financial measure to evaluate performance. We calculated residual income, we saw that the residual income exceeded the target, and therefore the divisional manager was entitled to a bonus. But we only looked at that from a financial perspective. We haven't considered any non-financial indicators or non-financial measures. So that's what we're looking at now in the second part of the required. We are looking at non-financial measures that can be used also to evaluate performance, but specifically in terms of the quality and efficiency of the manufacturing process. Now please note, this shouldn't be a long discussion. You are asked to list 4 non-financial measures. So you just list them. You don't need to discuss them in detail. And obviously you can't have any financial measures because the required is specifically asking for non-financial measures. So let's think about this. Let's first look at quality. What are some of the non-financial measures that can be used to evaluate a divisional manager's performance in terms of quality of the manufacturing process? Now guys, normally what will happen in a company is you'll have some sort of inspection throughout or at the end of the manufacturing process to check if the product complies with quality requirements that you have in place. So during this quality control inspection, obviously if the product passes, it moves on and it'll finally get sold to the customer. However, if it doesn't pass this quality control inspection and they find there's a problem, then obviously it's rejected, or maybe it's sent back and something needs to be changed in order to improve the quality, or it's completely scrapped. It just depends on the business and the nature of the manufacturing process. But obviously the number of products that are rejected, that will indicate the quality of the manufacturing process. You want that to be as low as possible. When your products go through quality control inspection, you want them to pass so that they can move on and be sold to the customer. They don't have to be scrapped or they don't have to be reworked, both of those costing the company a lot more money. And that's obviously a non-financial measure. So that's the first thing I would look at, the number of products rejected. Another thing is you might have a situation where a product does pass the quality control inspection and is sold to a customer, and the customer then finds that the product is faulty, and they obviously then return the product to the company. And in that case, obviously, it will also indicate a problem with the quality of the manufacturing process. So what you could look at over there is the number of customer complaints, or in addition to that, the number of products that are actually returned by customers, because both of those indicate potentially a problem in terms of quality. Then for efficiency, if we look at efficiency, a non-financial measure that can be used to evaluate divisional performance would be something like the speed of delivery. How long does it take the company to supply a customer after they've received an order? Because that will indicate whether the manufacturing process is efficient or not. If the speed of delivery, if you can deliver within 2 days, then obviously that's great. If it takes you a month to deliver, then obviously that's not great. Once again, take into account the nature of the product. Over here, we're dealing with instant cappuccino. So you can't have a situation where a customer is placing an order and they have to wait a month before they can actually get the instant cappuccino. That would be ridiculous. However, on the other hand, if you're buying a house and the house needs to be built, then obviously a month wouldn't be reasonable. You're looking more at a couple of months before you would actually get the product. So always just take into account the nature of the company that you're dealing with over there. But that would help you determine whether the manufacturing process is efficient or not. The speed of delivery. How long does it take you to deliver the product to the customer after receiving the order? So if we just jump to the suggested solution over here to make sure that we've gone through everything. So you can see the 4 non-financial measures that I've discussed is firstly the number of products that are rejected, so they don't pass quality control inspections, the number of customer complaints, the number of products that are returned by customers, and the speed of delivery. And obviously, if you have any other non-financial measure, you can also award yourself a mark. But please make sure that if you have another measure, it must relate to the quality and efficiency of the manufacturing process, not just any random non-financial measure. All right, so that then deals with part B of the required.